Happy Thursday out there, Team 42. It's your skipper here, Darius Delta, present our macro minute for Thursday, March 20th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, how soon until the Fed is providing liquidity via QE? Our answers are, at yesterday's FOMC, the Fed voted to maintain the benchmark federal funds rate at 4.5% and slow the pace of balance sheet reduction. The Fed lowered its growth forecast, raised inflation estimates, increased its unemployment rate forecast, and maintained projections for 225 basis point rate cuts this year, with Chair Powell stating that lower growth and higher inflation balanced out in policy considerations. Starting in April, the Fed will reduce the cap on Treasury maturities, rolling off its balance sheet from $25 billion to $5 billion per month to mitigate strain while keeping mortgage-backed securities cap at $35 billion per month. We've consistently reiterated for months that the Fed would end the Treasury portion of balance sheet runoff in the first half of 2025. Yesterday's reduction to only a $5 billion a month pace is a massive step in that direction. Yesterday's bullish response across asset markets was appropriate. If our medium-term fundamental outlook is reasonably accurate, the risk asset rally will likely fade within a month because ending fake QT is not the same as implementing QE. The lack of follow-through today is supportive of this view. Both Powell and Fed Governor Michelle Bowman recently advocated for adjusting the supplemental liquidity ratio, or supplemental leverage ratio, rather, SLR regulations to improve Treasury market liquidity and to address unintended regulatory consequences. In yesterday's All In podcast with Chamath Palihapitiya and David Friedberg, Treasury Secretary Scott Bessent confirmed the Trump administration is also on board with the reduction or abolition of the SLR. That is great news for investors because conservative estimates of its impact suggest it could free up an additional $200 to $400 billion in bank capital for treasuries or repo, which will be an indirect source of incremental treasury demand. Reminder, asset markets need QE in 2025 to prevent a global debt refinancing air pocket, and they will eventually receive it. If, however, QE is not supplied on a proactive enough basis, it is not likely risk assets have formed a durable bottom. Scrapping the SLR would be a big, nice step in the right direction and may limit downside in risk assets over the medium term. Be careful not to overreact to that statement, as limiting downside is not the same as forming a durable bottom. Traders, trade. Investors, be patient. Know your role, and most importantly, know your financial goals. You don't have to trade every wriggle in the stock market or in the crypto market to retire on time and comfortably. 42 Macro's large and growing client base is living proof of that. Transition to our 42 Macro dashboard. This is always a wrap up with a question from our client base. This one's regarding bonds. It says, hi, Skipper. Using the 10-year bond yield components as a proxy, I see the real yield and term premium components have contracted this year, while the 10-year break-even rate is flattish. I have just a few questions regarding these components. Do you think term premium will largely be ignored until we get closer to the debt ceiling becoming an issue again in the third quarter of 2025? Will the growth scare / policy uncertainty from this point be enough to push real yields down even further, especially given that markets are already pricing in more rate cuts than what the Fed has articulated? And then given that the Fed is viewing tariff policy, tariff impact as a transitory one-off shock to short-term inflation prospects, will a sequential upside surprise as the CPI and PCE from here be enough to push the 10-year break-even rate higher? So let me unpack each of those in succession. So starting with, do you think term premium will be largely ignored until we get closer to the debt ceiling impasse becoming an issue again? So we talked about yesterday how we essentially expect the debt limit X date, the default date, which they're not going to default, but the projected default date is somewhere between mid-June and late August. It's hard to be clear until we get to the other side of tax season, individual income tax season in late April, in mid to late April. So assuming that term premium, in our opinion, is likely to widen once the market gets a bit more clarity on the contours of the fiscal policy agenda, specifically as relates to extending and expanding the Trump Tax Cuts and Jobs Act. There's still some sort of fluctuations that they can do. There's still some levers that they can pull to make that package either they can make the package bigger on the tax cut side if they find offsetting cuts. And so we'll see if they can kind of what the ultimate size and scope of the package is. But the number one thing that we've been focused on here in our research is whether or not they use the current policy or current law baseline. If they use a current law baseline, then they're going to, they're basically only have enough money to kind of extend the Trump tax cuts and maybe add a this or that there at the margins. But if they use the current policy baseline, then they can throw in a whole range of goodies as it relates to President Trump's campaign promises on the tax relief side. So if they go down this current policy baseline, you're going to see a much bigger, a much larger hit, a much larger increase in structural treasury supply that's added to the market. And in our opinion, we think that's when term premium will begin to rise again as a function of that. So it's really just a function of that really critical choice that they have to make in Congress. And we ultimately think that based on President Trump's dominance of the Republican Party and how everyone's really fallen in line with the passage of the continuing resolution, with the passage of the reconciliation instructions, and obviously going back to February with the passage of the actual budget proposal. It's very clear that President Trump is the party's whip right now, and it's working. And so it's our belief that they probably are going to go down the current policy baseline, and ultimately we're going to see a much larger tax package from that perspective. So that will be negative from a term premium perspective, but obviously positive for the structural growth outlook. So keep that in mind. Will a growth scare / policy uncertainty from this point be enough to push real yields down even further, especially given that markets are already pricing in more rate cuts than what the Fed have articulated? The answer is yeah, absolutely. So right now, if you look at where consensus GDP estimates are, or where consensus sales and earnings forecasts are for S&P 500 companies, they barely budged. And so it's our belief that if we have a faster than expected slowdown in growth, and obviously the Fed is kind of now, I would say leading the charge. We're leading the charge. The Fed is following us, and we think investor consensus will follow the Fed in the coming weeks and months. If growth slows faster than what they're currently expecting, then the market will price in more rate cuts. It's not about what the Fed wants to happen. It's about what the market is going to price in as a function of that. And again, we could be wrong on all this, but if we're right, then what's likely to happen is the market will price more rate cuts in than two. It's 2.5 currently, and they'll so it could go down as much as probably 4 this year, because ultimately it'll think the Fed's behind the curve in that scenario. So you can definitely see real yields lower from here in a true legitimate growth scare, which we continue to believe is underappreciated by the markets, by asset markets. And again, we could be wrong in everything we're saying, by the way. It's not like we have some crystal ball here. We're just doing dozens of slides of research in our leadoff morning note every day. We're doing 150 plus slides of research in our macro scouting report every month to arrive at these conclusions, and those conclusions could be wrong. But again, I think we're pretty good at what we do here. I know we're pretty good at what we do here, so I have a lot of confidence in our forecast relative to most. But getting back into this, could the market price in more rate cuts than what the Fed has articulated? Absolutely, it will. It will certainly will if growth slows faster than what people are expecting, and we believe that it is likely to. Again, we have this significant fiscal retrenchment coming from DOGE, coming from the budget process, as well as the acquisition, the application of tariffs, which is a stagflationary shock to the economy. People have already forgotten about the significant slowdown in immigration. Where if you look at border crossings, they're down 88% in February. They were down 66% in January. Basically, you were basically reduced immigration to zero, essentially. I mean, not zero, but essentially. And so that's going to slow labor supply growth. That's going to slow job creation. That's going to ultimately slow the rate of consumer income growth. And so that's another headwind. And then you also just have steepening base effects from 2+ years of real final sales growing at or above 3%. So that's a tough comp to begin with. So you have a lot of negative things happening, not the least of which is the one-off kind of stagflationary shock to the economy from the acquisition of the imposition of tariffs. So there's a lot of negative stuff happening over the next, let's call it 2 to maybe 3 quarters that has not yet been reflected in GDP estimates or consensus estimates for sales and earnings on the micro level. So that, in our opinion, is a big market risk. Obviously, on the other side of that, you're going to get the QE if we're right. You're going to get the tax cuts. You're going to get the deregulation. So you're going to want to buy that dip if we continue to dip from here. But ultimately, we think it's a bit premature, even if we're in a multi-week rally, because that's what happens in bear markets. You have these multi-week rallies. So try not to get head faked if you're out there. That's one of our key takeaways from yesterday's macro minute. And then finally, wrapping up, given that the Fed is viewing the tariff impact as a transitory one-off shock to short-term inflation prospects, which is true. That's how tariffs have historically filtered through the economy. Will sequential upside surprises at CPI or PCE from here be enough to push the 10-year break-even inflate higher? No. The 10-year break-even inflation rate is highly correlated with growth expectations, highly correlated with stock prices, highly correlated with forward expectations of earnings. If we have a faster than expected growth slowdown, you're going to see the 10-year break-even rate decline, even if it's really not even if it's a misnomer, even if it's not really true, even if long-term inflation prospects are not materially being altered, that's just how the break-even market is historically traded, and we're not expecting a material departure from how it's historically traded. So, in terms of bond yields, I think what's more likely to happen from here is we probably get a proper growth scare, not this kind of 2 week growth scare that we've had thus far, or not. I don't want to be dismissive. Kind of 1 month growth scare that we've had thus far. We think that's going to deepen. If that deepens, you're going to see bond yields lower. Eventually, bond yields will find a bottom once they start to get credible signs from policymakers that the Fed put and or the Trump put has been achieved. And then you buy the dip, and it's off to the races on both bond yields and risk asset prices terms. So, we continue to view 1998 as a very legitimate market analog for 2025. And again, like I keep saying, we could be wrong about all of this. The market could have bottomed already. We could be finishing the year at 7,000 S&P and 150,000 Bitcoin. And that may very well be true. But based on everything we think we know as a function of performing, but I think is some of the best macro research in the world, more consistently and more fervently than our competitors, we think a lot of stuff is not priced in along that journey. So I would recommend, we continue to recommend clients be defensive. So we're wrapping up there. Darius Dale here, presenting our macro minute for Thursday, March 20th, 2025. Best of luck out there today. Everyone, have a great day. Best of luck out there. Have a great day. We'll catch you back here tomorrow. And go Bulldogs. Let's go. Beat Texas A&M. Cheers.